This is Let's Talk Energy, your go-to podcast for smart energy insights. I'm your host, Noah Brenner. Each week, we're bringing you an inside look at the dynamics shaping global energy markets through in-depth conversations with our RystadEnergy experts, as well as some special guests. In today's episode, we're trying to understand how companies have created value in the energy sector, both in the past and how they can do it into the future. Energy has not been the most popular industry for investors over the past decade or more, as we've seen the share of energy companies in the broader stock market decline compared to sectors like tech or healthcare. Nevertheless, some energy companies have performed exceedingly well, both in traditional and transition sectors. With power demand set to surge and forecasts showing oil and gas is likely to remain more resilient through the transition, parts of the energy industry look poised for sustained success. So, what is value creation in the first place, and what separates a successful energy company from one that might be struggling? Which parts of the energy industry have outperformed so far this year, and which ones might do very well in the year ahead? Finally, what are some structural and strategic trends that we're watching that define the sector's winners and losers over the next 5 years? I'm joined from Oslo by Lars Nicolaisen, Deputy CEO of RystadEnergy, to help us figure out where we can find value today and into the future in the energy sector. Lars, welcome to the program.
Hey Noah, it's great to be here.
Well, let's talk energy. We touched on this subject a little bit when we spoke in London on the sidelines of the RystadEnergy EMEA Summit in September. But I'm excited to actually dive into a little bit more detail than we were able to cover on the debrief. So, what does value creation actually mean? Some people might not exactly know what it is that we're talking about. Is it the same as just making money or having your share price go up?
The risk of becoming philosophical here, because it does indeed depend a little bit on the perspective taken. Different stakeholders may think and should think differently about what value creation is like. But I guess in a capitalistic perspective, which is the one we I think often take with a lot of our clients at least, it is about making money, and as such, it is about collecting more revenues than you incur costs. There are sharper definitions than this. But I think for this context, I think that is in a way the framing. But I will also remind everyone that costs is not just about the direct operational costs that you're incurring in any given project. It is also the financing costs, the so-called cost of capital. So at the end of the day, you need to be running at an operating surplus that is higher than your cost of capital. If you do that over a period of time, then you are creating value in a capitalistic framework. This is often reflected in any company's share price. So oftentimes you would use a company's market capitalization or share price to gauge whether it's going up or down, as to gauge whether the company is creating value or not. So it's a good proxy. It's not a perfect proxy, but it is a proxy for investors to think about whether companies are creating value or not.
But you said there are potentially other ways to look at this as well. So, what do those look like?
Depending on who you are, if you're a government of some country, if you're an NGO caring about climate, you may think about businesses as something more than profit generating entities. They are often associated with externalities. These are consequences of companies running their business. Such consequences or externalities can be positive. For example, they can generate employment, jobs for the community around you. They may both directly and more importantly, indirectly. And they may have, for example, some environmental impact of their business, which again could be both positive or negative. And so depending on who you are as a stakeholder, you may or may not be attributing value to those externalities that are associated with any given business running their operations or creating projects.
What sectors within energy have been creating value through, say, from start of the year through now?
2025 for energy broadly has been a challenging year, because 2025 has been a year where energy prices across a wide array of energy carriers, both oil gas, and a lot of power markets globally have seen a deteriorating trend in terms of price evolution. And when prices for energy ultimately decline, it has a tendency of trickling through to whoever is in those value chains, as making it difficult to create value. That's at least easy to grasp if you're thinking about anyone selling energy. If you're selling at lower prices than you did yesterday, then it's tough to make the case that you are creating value. However, not everyone is exposed directly to selling energy as such, and as such not directly exposed to that price signal. The few sort of sectors that comes to mind where we have seen real tangible value creation this year, let me go to the US, let me go to the data center boom that is happening in the US, and how that has created a huge call for natural gas equipment to convert natural gas into power, which ultimately fuels these data centers, or has become a key source of energy for these data centers. And particularly the equipment providers of such gas turbines have done exceptionally well, with a lot of order books building, and with a lot of pricing power. They have almost twofolded their prices that they are charging their customers to. So that's one sector where there's been a lot of value creation, again in a capitalistic framework, and stock prices surely being reflective of that. And you can also go to other supplier segments in energy, EPC in general, engineering, procurement, and construction, i.e., companies that help build energy infrastructure of some sort, have also done fairly well in 2025. One subsector here that comes to mind is the subsea EPC industry, where there's been a beneficial supply-demand balance. There's been quite a lot of new subsea projects coming to the finishing line over the past couple of years, and as such now going into construction mode, where these subsea EPC names have been called upon to the benefit of those suppliers gaining pricing power. So I think for me, 2025 has been a year of where some select supplier segments have done very well. In a year where generally making value in energy has been rather challenging.
You were on the Financial Times Next Five podcast here earlier in the month, and you said something there that I found interesting, and I think relevant here, which is energy is inherently cyclical. And then you described how somewhat the cure for high prices is high prices. We see investments rise as prices rise, and then trough as prices trough. But you said again, it's these price signals that often drive value creation for those owning the resource. And so in energy, I mean, is value creation as simple as hitting those cycles right? Or is that really kind of too reductive when we're thinking about how to create value long term?
It's probably an oversimplification to say that that's the one and only recipe for creating value in this space called energy, or being an energy producer. But I will go far in saying, if you can understand those cycles, you are at an advantaged position in creating value, because I think history has taught us that those who can understand and time their investments a bit counter cyclical, they are in a very, very good position to create value. And yeah, you're right. I mean, you can actually describe the system of how the price signal, when it's high, incentivizes investment, which then in turn sets the stage for a lower price environment sometime down the road, when those investments turns into supply of energy. And this is a system that you can actually model, and we do a lot of that modeling here in RystadEnergy, and it's part of the service and advisory work we do with our clients. Again, when I talk about it like this, maybe it makes it sound simple. The reason it's not simple, and the reason why it's an oversimplification to say that this is the only thing you need to sort of understand, is because there are many such cycles that are superimposed on top of each other. Because in addition to this sort of capital chasing a price signal cycle that we just talked about, there are also political cycles that also impacts the premise of being an energy producer. There are seasonal cycles that are playing out. There are also daily cycles in parts of the energy system, with night and day, etc., that also creates cyclicality in this. And then there are shocks that are imposed into the system, which are not really part of the cycle, but that really that creates a pulse into the system, which are really hard to account for. COVID being one such shock with all the repercussions it had for energy. Supply side shocks could be outages of production of energy around the world. Demand side shocks may be setbacks in whatever pockets of the economy, which are then all of a sudden demanding much less energy. So there are all these factors that are superimposed on top of each other to create a rather complex picture to understand. But yes, understanding that the energy markets are inherently cyclical is a very good foundation if you want to create value in these value chains.
I wanted to switch gears and look ahead, and talk about where you see opportunities for value creation, say end of this year and then through into next year. What are the things that you're keeping an eye on?
I think there are a couple of themes, three themes that comes to my mind where I really see potential for creating value in years to come. And one of those themes we have already touched on, which is the U.S. and the energy landscape in the U.S. and particularly the natural gas value chains in the U.S. I see them as very, very beneficially positioned against some mega trends globally, but particularly in the US. And one of the mega trends is AI and how the data center boom is really, really coming to fruition in the US right now, which is calling for, among other things, natural gas. And by the way, it's very much backed by the new administration in the US, who really wants the US to become the superpower of AI. So there's strong sort of governmental backing to that trend. And then another trend, which is also backing in natural gas, which is also backed by the new administration in the US, is LNG. And this idea of unleashing US energy, particularly US natural gas in the form of LNG, to global markets. This also is a demand surge on US natural gas. And so my one idea is the upstream environment in the US as a natural gas producer is going to be a beneficial place to be because of these very strong demand drivers for natural gas. So that's one idea. Another idea that I have about creating value also has to do with being an upstream producer of molecules, be it oil and or maybe even more importantly gas. It's about being advantaged from a geographical perspective.
Okay.
And that is about producing molecules close to demand centers and close to where the customers are, because it's become increasingly more difficult to trade these things as global commodities, and we can get back to that later. And one of the regions that comes to mind is, for example, the North Sea, which at the outset doesn't really screen as an advantaged barrel basin because it's an aging basin, a mature basin with very marginal smaller project in it, but it sits strategically from a geographical perspective very beneficially positioned close to the European continent that will continue to demand gas for years and decades to come. And my third idea is around renewables and creating value in renewables, which is not as easy as we maybe thought. Because on the one hand, renewable producers have been blessed with a continued cost compression. Cost of solar, cost of wind has come structurally down, as I think everyone listening to this podcast would know, somewhat sort of interrupted by some trends during COVID, but still there's a very strong cost reduction agenda in the world of renewables, which is all else equal very, very beneficial for value creation as a producer of renewable energy. However, it turns out that the intermittence of this production signal creates some systemic effects for the power markets within where you operate, and this is in turn materializing as price cannibalization, i.e., the average producer of solar electricity and wind electricity is not earning average power prices. It is earning less than average power prices in its market because it's producing electrons at the very same time as all the others that are producing solar and wind. So there's a clogged system at periods of time. And so you need to change the business model somewhat in the world of producing renewable electricity, partly by or either by firming up your production by deploying storage next to your production of solar and wind, or to build a portfolio of dispatchable generation technologies next to your solar and wind generation, i.e., for example, natural gas power. I think that's the key to create value in power markets as a producer of energy in years to come.
What do you think companies are getting wrong, I guess, right now in terms of you mentioned that cannibalization, perhaps not getting the prices that are prevailing for their renewable power. And how can they get it right when you're dealing with these, moderate to high penetration renewables markets?
We've tried to coin it here at RystadEnergy as the new hybrid reality of power markets, i.e., the reality within which VREs, variable renewable energy or electricity technologies, coexists with the old system of dispatchable power sources such as coal and such as natural gas. But these hybrid effects start to occur when VREs as a share of the overall generation mix surpasses certain thresholds. For solar, it's about 25%. For wind, it's around 30 to 40%. Whenever VREs, solar and or wind, becomes more than these percentages worth of total generation, these systemic effects start to really weigh in on the system. And one of the facets of that is that it trickles through to price cannibalization, which in essence deteriorates the business case, deteriorates the ability to create value for anyone who produces electricity via a energy only model, i.e., you are only plowing electrons out whenever the sun is shining or when the wind is blowing. If that is your business model, which is a simple setup of having a solar farm or a wind farm producing energy whenever these weather-based resources are allowing you to do, then it is extremely difficult to create value.
It's a battery, it's firm power in the form of, say, natural gas or thermal generation, something that allows you to capture those prices when they're not saturated in the market.
But you're right. I mean, in first order, that's the natural response to complement your portfolio of generating assets with storage or something that is dispatchable. But you can also think about other strategic avenues that you could walk down in order to capture more value. You could vertically integrate, as it is called, downstream, i.e., you could become your own customer because after all, you're producing something that is very affordable all of a sudden. So if you have a business that needs power, you can integrate these two businesses and become the off-taker of your own product. And some of the big oil majors have done this successfully, like Total Energies in Europe. They are effectively becoming the off-taker of the electricity that they are producing from their renewables arm. So that's a way also of capturing this value of cheap electricity that you are producing. And there are other means as well. For example, there's more value to be captured in trading when prices are becoming as volatile as they are. I mean, everything that I'm saying now is a story about price volatility, the influx of VREs creating price volatility in these hybrid power systems. And all else equal, more volatility gives more opportunity for traders in this space. So if you can integrate a trading arm, there's probably more value that you can create. But to your original point, the key to unlocking some of that also in the world of trading is if you're able to store some of this. So electricity storage, power storage is a key asset class to complement the previous energy only business model in order to create more value in tomorrow's or hybrid power systems.
I want to shift to natural gas. U.S. gas is I got to say this is one area where I might need a little bit of convincing about the value creation opportunity as someone who's covered that sector for quite some time, and it always seems like that gas price upswing in the U.S. is just around the corner, but there's an immense amount of resource there, and so it's taken a lot of demand development. But why is now the time that you see when this could actually happen, particularly for those resource holders? And will it be the resource holders, I guess, that benefit here? Or, as you pointed out earlier in the program, might it be some of those companies that are providing services to the resource holders when it comes to who's going to benefit the most?
I think the Henry Hub Prize will be a key beneficiary of this. And to your point, there's been such promises made in the past. Again, I did reference the two key pillars of my thesis being governmental backed demand drivers from the world of AI and the world of LNG. Those two seem very strong drivers for me for demand for natural gas to the US as such. Now, pair that with a view of supply where I think it's fair to say that there's vast amounts of gas available in the US. Some of it, however, is somewhat landlocked and not able to, for example, reach the LNG facilities that are being built out along particularly along the coastline in the south in the US. So not all gas is that relevant for the LNG demand wave, and we are seeing some deteriorating well results in some of the well-established natural gas play, like in the Haynesville, for example, which means that it's becoming incrementally more costly to provide that marginal unit of natural gas into the system. So while there's abundance of resource, it is not abundance of resource at a very low cost. So if you buy my argument about a too strong, I would say, secular demand drivers for natural gas and a cost curve that has to be climbed upstream and marginal sort of costs will be setting the price, all else equal, we believe in an elevating Henry Hub price for the foreseeable future, frankly. And I will say that the resource holders should be key beneficiaries of this. But to your point and some of the points made earlier, we also learned with an historical reference that during the gold rush, the people making the money was not necessarily those exploring for the gold, but those selling the picks and shovels. I think everyone have heard that. And I think right now we're seeing that vividly play out, right? I mentioned earlier how the equipment providers have been the key beneficiaries. But I just do see the US lower 48 natural gas value chains as being a value chain where again value can and will be created in the next year and years to come, and then I think you can make different calls on where in that value chain to play it. But my argument is that I think the resource owners themselves should take their fair share of this value creation going forward.
Is natural gas just competing against other natural gas kind of in that way? Same with the equipment providers, or is there an argument that they need to be competitive with the cost of batteries and the ability to sock away some of this additional renewable power that's being generated and maybe either at subpar prices or curtailed altogether? Is there a gas versus electricity, I guess, consideration here?
One of my two key demand drivers for nat gas here, I referenced as AI and data centers. They're not consuming nat gas as such, they're consuming power. It happens to be that natural gas has been a key route for them recently, and hence the beneficial environment that all these equipment providers have found themselves in. But I also referenced how the equipment providers themselves have been able to escalate prices for the equipment, particularly the turbines that they're selling have almost doubled in price. And again, all else equal, this lowers the competitiveness of natural gas as a source for power to these data centers vis-a-vis its competitors who would be renewables based via storage. So you're right, this is not something that is playing out in isolation, and you cannot see these costs and these prices going too far before you start seeing the pendulum swing in the other direction. In fact, most recently we've seen an interesting evolution right here, where the main route to create power out of natural gas is to deploy a traditional gas turbine. However, there are alternatives to that. You can use a fuel cell. Oftentimes, people think about hydrogen as being the key fuel into a fuel cell, but there's also multi-fuel based fuel cells that can also accept natural gas. And that's an alternative to gas turbines. And what we've seen most recently, as turbine prices have almost doubled, we have seen that becoming a more relevant route, which kind of just underscores your point with elevating prices and that being a proxy for value creation for those who sell that equipment. You also see dynamics unfolding where other alternatives are becoming more competitive. So it's not a given that this will play out purely in the benefit of the natural gas value chains.
Break down this advantaged molecules thesis for me.
What we are waking up to now is a reality where markets are just becoming less global. And this is not about energy. It's about the world of geopolitics. We are not trading with each other with the lowered barriers that we've had in place since the year 2000, when China in earnest became a huge part of the global economy. We are waking up to a reality with trade barriers being built around ourselves. And so therefore, we are seeing energy security having risen significantly on the agenda and on the focus list of global leaders. And energy security for many is finding a trusting trade partner and ensuring that that trusted trade partner can deliver amounts of volume or of energy for you over periods of time. Again, there is such a trusted relationship between the North Sea and the country where I'm from, Norway, to continental Europe. That trusted relationship has become is a value creator now for the North Sea basin, because it gives the North Sea basin even more runway for their products.
Can we say that this plays out in other places where we have, say, a resource-rich basin and a resource-poor major market? Or, I mean, kind of where else, how else does this set up and where else might we see it?
It is about resource poor countries being in need of resource rich regions where there is an established and well functioning trade route, which often is facilitated by proximity, i.e., short distances. And really, I mean, this thesis doesn't have to be more novel than thinking about Russia and how Russia has been taken out of the equation by many, and the void that Russia leaves, and who has the ability to sort of fill that void. Again, in terms of other examples, again, let's go back to the US, and we've already talked about the LNG opportunity that the US have, and an opportunity that the new administration is seemingly very willing to jump onto. This is about the US stepping in with supplying natural gas to the world via the route of LNG. And this is partly a response to these advantaged molecules. I think the U.S. molecules are advantaged in the sense that U.S. have been a trusted trade partner for many over a long period of time. And then you can also draw a little bit of a question mark around that now, given where we are and the kind of headlines, I guess, the new administration have created around their tariff policy. But you could also turn it around by saying that the new administration has turned energy into a lever that they seemingly intend to use in their negotiations in trade policy. We've seen that in the negotiations with EU, and we've seen it in the negotiations with UK, which again goes back to the theme about US natural gas in the lower 48 seemingly being in a very beneficial position, also with regards to this right molecules in the right places theme of mine.
We're taping this shortly before COP30, but you're going to be heading to Brazil to attend COP30, and we see it as quite a historic COP. We've got countries bringing their new NDCs, their new commitments to reduce emissions, but it also comes, amidst a backdrop of backlash against climate policies, and particularly the Trump administration's rollback of many of the U.S. climate goals. Are there still avenues to create value through cutting emissions? Or is this something where emissions reduction has kind of become a nice to have thing that happens while you create value in other ways?
For sure, there's been an evolution here, hasn't it? I think the sentiment around the broader topic of energy transition and the imperative about fighting climate change I think that has changed somewhat over the past couple of years, and with the new administration in the US in place, I think that has been a driver for this. Again, we talked earlier about what value creation is, and I referenced how emissions is an externality that if we can put a price on it, we can internalize that externality, i.e., turn it into an explicit value creation theme. Now, governments holds the key to internalizing such an externality by putting for example, by putting a price on carbon through whatever scheme they put in place. All else equal, I think we have now seen a reduction in those mechanisms. There's less, for example, tax credits available in the US right now to deploy emission abatement type technologies. So I think all else equal, there's a little bit less opportunity now in 2025, 26, 27 than what it was some years ago because of this sort of swing in sentiment. However, I still see emission reduction as a key arena for creating value going forward. So there's about 39 gigatons of CO2 globally annually that we're trying to sort of cope with. One of those gigatons ish comes out of the upstream oil and gas industry themselves. So the Exxons, the Chevrons, the Shells are emitting this as a function of their own operations. These are companies that have in to a certain extent internalized the externality by incorporating a value on carbon in their own planning assumptions, not just because they're part of any given sort of trading scheme like EU ETS that explicitly puts a price on carbon, but many of these organizations have put it upon themselves that they want to reduce their own carbon footprint. They've been scrutinized by investors and by other stakeholders over the years, and they've made a strategy around and guiding on reducing their own, particularly scope 1, scope 2 emissions. And I think many of these companies are using numbers like $100 a ton for their internal planning assumptions, which then, if you do a simple multiplier exercise, a gigaton worth of emissions in this industry that has put it upon themselves that they should be abating this and maybe doing so at the cost of $100 a ton, you'll get to $100 billion of an opportunity. So I would say there's still opportunity. This is obviously a very simplified piece of math, and not all oil companies out there are willing to pay $100 a ton. But I think there's big opportunities here for companies to come in with a value proposition around reducing emissions, also in the world as it looks in 2025 and in 2026. So as much as the pendulum around the energy transition has swung somewhat, there's still, I would say, value creation opportunities in the space of emission reduction.
You've laid out a number of areas, whether it's in kind of your big three thematic ideas, whether we've highlighted the emissions opportunity, a lot of areas to create value in the energy space. But at the same point, we haven't necessarily seen investors respond to energy, especially positively, over maybe perhaps the past decade or so. The share of energy in the total stock market has declined and not really climbed necessarily since some of the troughs. So why is it that you think energy maybe isn't resonating with investors the same way that a tech or a healthcare or some of these other sectors are?
The secular trend is that as economies mature, the role of energy diminishes somewhat as a share of the economy and a share of GDP. Because you get to this sort of saturation point when you're not really, your GDP growth doesn't come with a prorated amount of energy growth. So you cannot expect energy to sort of sustain its share of the economy as the economy matures. That's a very big theme that plays out over decades, not over years, but still it's worth to have in the back of our heads. Now, obviously, over the past 20 years or so, that phenomenon of certain economies, including the US and Europe, coming to that sort of saturation where energy demand doesn't grow in tandem with the overall economy growth has been masked by the fact that there are developing economies, and China comes to mind, that has been such vehicles for driving that global energy demand, right? So as such, there's been a significant growth for energy demand globally. And since, to your earlier point, energy markets, particularly oil, have been very global in nature, Western companies with headquartered in very mature economies could have benefited greatly from those demand pools growing so fast in developing economies. Now, I guess it's fair to say that some things are also changing in some of these developing economies. And I mean, we're seeing contours of China, particularly oil. Oil demand in China is not growing as fast as it has done in the past. And given that the energy industry, again, looking at it from a big sort of sectorial lens, has been very heavily weighted by these oil majors who has been earning their revenues and they're creating their value around oil and also to a certain extent gas. The fact that some of these key demand centers are tapering a little bit from a growth perspective is part of weighing down the value and the prospects for value creation in this sector. I will also say that I think the whole construct around the energy transition, which again has been sort of swinging a little bit back and forth, or maybe a little bit back most lately, the construct sort of questions what the future energy system looks like. And so when you start questioning what this future energy system look like, i.e. you impose uncertainty into the future, you start discounting the future prospects of any given business model by a higher discount factor. And in the world of value creation, that matters. And I will say that again, particularly the oil majors who weighed heavily into these indices of energy companies, they are probably being discounted heavier. Their future, the long-term future, is being discounted heavier than what it did in the past, because in the past it was sort of this infinite sort of growth runway seemingly for oil and gas demand. We're seeing a clear contour of that not being sustained in the long term, and hence the value of those out years are being diminished. So I think this is part of explaining why energy as a mix of a bigger basket of the economy or of any given stock basket, it has been diminishing a little bit over time.
I was able to sit down with Jarand Rystad, who's the founder of and CEO of RystadEnergy, in August. And one of the points he made that really stuck with me, we were talking about the energy transition, is that there was going to value within the energy system as we looked out further. This is decades out into the future, but would kind of naturally accrue to consumers as the energy system became cheaper and more efficient at both generating and distributing power. Um, so I guess what I'm wondering is, does that mean it's going to be more difficult for companies to create value into the future as we do see that energy system evolve?
So I think the absolute values to be created will probably diminish as we go forward and transition into a more manufacturing-based energy system as opposed to a resource-based energy system. Those with privileged access to resources in the past or current system, privileged access to oil, natural gas, and coal for that matter, has been blessed with value creation, creating opportunities. The tomorrow's energy system is one about manufacturing infrastructure, manufacturing components like solar panels, like wind turbines, like grid systems, and it's about a manufacturing process, typically with slimmer margins in it. And again, like Yaran, I'm sure referenced in your talk, we are seeing a future where energy prices will come down relative to those prices we've had in the past, and that is another way of saying that there will be a value transfer from energy producers to the consumers, which means that there is less value to be captured by the producers. That said, let me also maybe circle back to where we started today's conversation around what is value creation, and cost of capital is also an ingredient in that, and lowering your cost of capital enable you to create more value. And in tomorrow's energy system, you will have less risk. These energy companies have in the past taken on a lot of risk, producing oil, gas from pressurized reservoirs, or mining coal are risky operations. A lot of people involved, a lot of high pressures involved. So it's been a risky business, and your cost of capital would have had to reflect that risk also. The kind of capital you can attract into the manufacturing-based energy value chains are different because the risk profile of what you're doing is just different. So there's a lowered cost for the energy value chain in terms of not just the equipment you're buying, but also the cost of capital to buy that equipment. So that in isolation means a higher opportunity to create value. So it's a little bit of a yes and no to that question, Noah.
Well, excellent. I think that's a great place to wrap up our conversation. Lars, Eirik, thank you so much for joining us.
Thank you, Noah.
Let's recap. Companies in the energy services sector have been among the leaders in value creation over the past year, as low commodity prices have created a tough environment for companies selling oil, gas, and power. In the year ahead, we see great opportunities for companies that are adapting to new hybrid power markets, companies with exposure to U.S. natural gas, and oil and gas producers with advantaged locations. such as those in the North Sea. Looking ahead, creating value in energy may get more difficult through the energy transition, but it will also offer opportunities for companies as the risk profile in the energy industry changes. Thanks for listening to Let's Talk Energy. This podcast is a RystadEnergy production, produced by Laura Rodriguez-Skaug and Bada Og. Check out the show notes for further analysis of the topics we've discussed today, and connect with us on social media. We're at RystadEnergy on all your major platforms. While you're there, hit that like button, subscribe, and leave us a review. You can also keep up to date on our website. If you'd like to send us a question or reflect on today's show, feel free to email us directly. It's podcast@RystadEnergy.com. And most importantly, don't forget to join us next week for more Let's Talk Energy.